Advanced Financial Accounting PowerPoint presentation. In this presentation, we will discuss foreign currency transactions. Get ready to account with Advanced Financial Accounting. Foreign currency transactions. So remember, when we're thinking about foreign currency transactions, we're thinking about them from the perspective of the U.S. company in U.S. dollars. So we have our currency that we're making our financial statements in. We're measuring all the stuff on our financial statements with the measuring tool that we need to be using. That's going to be the U.S. dollar. That's going to be our standardization. And then anytime we have foreign currency transactions with something other than U.S. dollars, then we want to see them from that perspective, right? Because when we put them on our financial statements, just like anything else, just like inventory, if we were to value units of inventory or to value stocks and whatnot, we need to value them in terms of our measuring tool, which of course is the US dollar. So we have the economic activities denominated in a currency other than the entity's recording currency. So if we have transactions, then therefore, of course, we're having transactions taking place. You can almost think of it like a bartering situation, right? We're trading something other than the currency that we basically do business with, right? And so then we have to value just like we would anything else in terms of the US dollars. So that could include purchase or sale of goods or services, imports and exports when the prices are stated in foreign currency. So if we're purchasing something in foreign currency, then of course the assumption then is that we're going to be paying foreign currency, right? We're going to be paying something, and that would be similar to a barter situation because we're paying in something other than the currency that we are using, and therefore we will have to value what it is we exchange, foreign currency, with the use of the US dollars. If we purchase something for US dollars and spend US dollars, or if we sell something in terms of US dollars, then if we're going to get paid in terms of foreign currency, I should say, if we're going to get paid in something in foreign currency, that would mean that we're receiving something in like a barter type of situation that we're then going to have to value just like we would inventory or stocks or anything else in our measuring tool, that being the US dollars. Then we have the loans payable or receivable in foreign currency. Same kind of situation there. That would be a foreign currency transaction. Purchase or sale of foreign currency forward exchange contracts. We'll talk more about forward exchange contracts, and they'll really come together once we start to think about them in context with practice problems. Highly recommend looking at practice problems with foreign exchange currency transactions, and especially if you're going to get into the point, which we will, with forward exchange contracts and the concept of hedging the risk of foreign currency variations and whatnot. So then we have the purchase or sale of foreign currency units. Once again, these are going to be foreign currency transaction. So foreign currency transactions denominated in a foreign currency need to be translated into the currency the reporting company uses for financial statement purposes. So again, just like anything else, if it's a foreign currency, it's a little bit deceiving because we say, hey, it's currency. It's like cash. It's liquid like cash. It is very liquid. It's a very liquid asset, and we can't spend it, and purchase things in the similar fashion. But it's not the thing that we use to measure our financial statements. If we're measuring our financial statements in U.S. dollars, we got to measure our financial statement in one standardized unit. It wouldn't make sense for us to measure our financial statements if we were to measure something like how high is a basketball hoop or something. It wouldn't make sense for us to say that it's so many feet and so many yards at the same point in time. That it doesn't make any sense to use different measuring tools. We have to standardize the measuring tool. Our measuring tool, US dollars. Therefore, the foreign currency, although it's like another measuring tool, to us, it's going to be basically another kind of asset or liability thing that we're going to have to value in terms of the US dollar. So then we're going to say this means that account balances denominated in a currency that is not the entity's reporting currency needs to be adjusted to reflect changes in exchange rates during the period at each balance sheet date. So at the end of each balance sheet date, if we have anything on the books that we had to revalue. For example, if we have a payable on the books that we're going to be paying in foreign currency, or if we have a receivable on the books in which we're going to be receiving foreign currency, then it would be similar to if we had stocks or bonds on the books at that point in time, right? Because if I had stocks on the books and I know that they're publicly traded stocks, then because there's a market for it, I can then go in there and say, hey, look, the current rate is this. I have the ability to do that with stocks because they're standardized if they're traded on a publicly stock exchange. I can go back in there at the balance sheet date and say, hey, look, there's been a gain or loss. How do I know? Because these are publicly traded items. People are trading these, and they're the same things that I have. Therefore, I know what the rate is at this point in time. That's not the same thing as if we had something like a building. Notice if we had something like a building, then we have a problem there because the building is unique in nature. There is no other building just like that building. There's no market that's going to tell us exactly what the value of that particular building is because it is unique. And that's why we have this concept of depreciation and whatnot. And that's why there's some problems. There's some questions as to whether we should be revaluing something to the current value or not, or if that's possible, or when it's possible. With regards to stocks that are publicly traded, we start to lean towards, the tendency is to lean towards, well, we should be revaluing this thing because we know what the current market rate is given the fact that there's a market. Currency is a similar kind of situation. We know the exchange rates because the people are exchanging them all the time, and we'll do a similar kind of process. We'll say, well, given that case, if we have an accounts payable or receivable where we're going to be paying or receiving in foreign currency, then we should revalue that at the balance sheet date to whatever the current rate is at that point in time to properly reflect the financial statements as of that point in time. The adjustment needed to equivalate US dollar values will be a foreign currency transaction gain or loss for the entity when exchange rates have changed. So whenever we present value something, we have the same kind of problem that you might think of having if you had stocks, right? If you're revaluing the stocks. Obviously, if we have not yet sold the stocks and we revalue them, saying they're now higher or lower than they were before, we know that because of the stock market, then we have a difference that we're going to have to deal with on the other side of things, which would be typically a gain or a loss. So we got to record the gain or loss somewhere. Well, same thing here. If we're saying that the receivable or the payable has now increased or decreased due to the difference in the value of the currency being received or paid and our current measuring tool value, the dollar, then the difference is going to have to go somewhere, and typically that's going to go to the income statement as a foreign currency transaction gain or loss. So here's a quick example here, and again, the best way to really get this is run through examples. We'll have many example problems in Excel and in just OneNote presentation examples, but recommend running through those. Assume a U.S. company purchases pounds from its bank on January 1st, 2000 for use in future purchases from a foreign company. So the amount that we're going to get is 6,000 pounds. Is it going to be foreign currency units? We're going to say they're pounds. Direct exchange rate is going to be $1.20 for each pound. Okay. Assume a U.S. company purchases pounds from its bank on January 1st, 2000 for use in future purchase from a foreign company. So we're going to be getting pounds then. So the amount we're going to get is going to be 6,000 pounds. So the direct exchange rate is $1.20 for 1 pound. So if we want to get 1 pound, we've got to pay in dollars $1.20. So the payment to the bank then, if we were to record the payment to the bank, we're going to be paying $7,200 in order to get the 6,000 pounds. In other words, we're going to say, all right, we need 6,000 pounds, and we've got the direct exchange rate, which basically is in dollars, right? It means, hey, if you want 6,000 pounds, this is the price, basically per pound, right? And so we're going to take that 6,000 foreign currency units and multiply them times the direct exchange rate, 1.2. That means it's going to cost us in dollars $7,200. So again, the scenario being, we can imagine that we're the U.S. company. We see something in London or something like that, and we're saying, hey, we want that. And the price tag says 6,000 pounds. We've got to pay them 6,000 pounds. We can't pay them in dollars. We need to pay them in pounds. So we're going to say, okay, we need 6,000 pounds. What's the current exchange rate? Well, the direct exchange rate is 1.2. So it's going to, if we want to get 1 pound, it's going to cost us $1.20. Therefore, 6,000 pounds is going to cost us 6,000 times the direct exchange rate of $1.20 or $7,200. We spend the $7,200 in order to get the 6,000 pounds. When we get the 6,000 pounds, we don't put it on our books, on our books for financial accounting in terms of pounds, because that would be like us trying to measure something with two different standards or units of measures, right? We're trying to measure our financial statement. We have to use one standardized system to do that. and that's going to be the U.S. dollar. So and it's just like anything else. So note what we got are 6,000 units. You can think of them. If we had inventory units, if we got 6,000 inventory units, we wouldn't put the inventory units on our books as 6,000 units of inventory, because again, we can't measure in inventory units. We have to measure them in dollars. Or if we were to purchase equipment or something like that, we wouldn't put the equipment on the book as one forklift. It's really pretty much the same thing. If it was stocks or something like that, we would revalue them. So we're going to do the same thing. We're going to put it on our books, the foreign currency in units. And I think one of the closer examples is basically stocks. You can think of it as stock because they fluctuate in a similar way. And you'd say, well, we're going to put that on there in the value of US dollars, which in this case is the 7,200 US dollars. So this would indicate then that we're holding on to foreign currency, in this case 6,000 pounds. We have 6,000 pounds, which we're valuing in terms of US dollars at $7,200. Just as we would if we had stocks. If we had so many stocks of a company, we would say this is how many stocks we have that is valued in US dollars, not in like the number of stocks. Okay, so now we have 7,200 on the books for foreign currency units, which represents the dollar value of the 6,000 pounds, which we are actually holding. Now, as time passes, then the exchange rate is going to differ. It's going to change. And we'll call it the spot rate right now, is going to change. That would be the current exchange value. And so if we're holding on to 6,000 pounds at a later point in time, it's at any future date, just like stocks, the price is going to change at any given time. We're not going to change it every day, to reflect the current value, although we probably could, because again, at any given time, there's a current market for it, just like if we were talking about publicly traded stocks. But that would be too tedious for us to do. We would typically do it when we need it to make a transaction and or at the balance sheet dates, right? So we would have adjusting entries basically at the month end or year end, and at a point in time when we need to revalue it in order to make basically a transaction. For example, if we were to spend the 6,000 pounds, we would want to revalue it basically at that point in time, and then spend it at that point in time using the reflective current valuation at the point in time that the transaction is recorded, so that we can reflect on our books in dollar equivalents what the transaction is doing. So later on, when one of those things happens, when either we want to spend the pounds or at a balance sheet date, we're going to have to check what is the current exchange rate so that we can revalue our pounds in a similar way as if we had stocks or bonds and we wanted to revalue them at any given point for similar reasons. So now on July 1st, 2000 x0, we're going to say the exchange rate is now 1.1. So if it's 1.1 right now, we're going to have an adjustment. We're going to say, all right, well, now we've got 6,000 pounds, and we multiply that times the exchange rate of 1.1, and that's going to be 6,600. We had put it on the books at 7,200, and now it's really valued at 6,600 given the current exchange rate. So if I subtract this minus the 7,200, we're going to get a $600 difference. That $600 difference is going to result in a loss that we're going to have to record. And if we think about it, why would it result in a loss? Well, because before it took $1.20 to get 1 pound, to buy 1 pound. And now it takes $1.10 to buy the 1 pound. So now we're saying that the foreign currency, the pound, has now gotten weaker, right? Because to get 1 pound, it only costs $1.10, and before it cost $1.20. So the pound has gotten cheaper, or it is weakened relative to the dollar. The dollar has gotten stronger relative to the pound. We're talking here about kind of like an investment. We're holding on to pounds. So we're holding on to something that has gone down in value. So that means that we're going to have a loss. So we're then going to have the debit go to the foreign currency transaction loss, the credit then go into the foreign currency units, and that means that 7,000 that we had on the books before, the 7,200 minus the 600, is going to give us the 6,600, which once again was the 6,000 times the current rate of 1.1, the 6,600. Now you can also calculate this difference, and it's useful to note by taking the difference between the rates. So we're going to say 1.2 minus 1.1 times the 6,000 pounds that we have on the books, there's that 600 again. So we'll do many transactions like that in our practice problems. Highly recommend going through the practice problems. Import, export, foreign currency, no forward contracts. So we have then what's going to be, the general process that we'll go through. First, we're going to have the transaction date. So we'll record the purchase or sale transaction at the US dollar equivalent value using the spot direct exchange rate. So let's say we have a purchase that took place at this point in time, and let's say we purchased inventory or equipment or something like that, and we're going to pay for it on account, meaning we haven't paid for it yet. We're going to pay for it in the future, but we've received the inventory or the equipment at this point in time. We're going to put it on the books at this point in time using the spot rate, the current exchange rate, even though we may have an accounts payable in that case on the books that we're not going to pay until some future point. So typically, again, we're kind of valuing what we're purchasing in that case using the spot rate, meaning the current rate at this point in time. We've got the inventory, we have the equipment, then we're going to record it even though we haven't yet paid for it. And that then will result in the fact that when we pay for it later in a foreign currency, then there could be some fluctuation in the foreign currency, valuation between the time that we purchase something and the time that we make the payment. So then if we have a balance sheet date, let's say this will typically be the end of the year or the end of the month when we typically do adjusting entries at the end of the time period. So after the transaction in the first one here, we may have an accounts payable or a receivable on the books, which is in foreign currency, meaning we might have bought something on account, at which point we might be paying something in the future in foreign currency or receiving something in the future in foreign currency. That means as of the balance sheet date, we're going to have to make an adjustment because there's going to be a change, of course, to the difference, the spot rate from the date of the transaction to the balance sheet date. So we're going to have to adjust the payable or receivable to its US dollar equivalent and end of period value using the current direct exchange rate. So obviously we'll have to revalue our receivable or payable if we're going to receive or pay in foreign currency using the current exchange rate, the current spot rate. Recognize any change, gain, or loss for the change in rates between the transaction and balance sheet dates. So notice what we're doing here is we have this, like in our example, if I was saying that we purchased inventory or equipment, we put it on the books using the original spot value, meaning we valued it using the current transaction, date to value the equipment at that point in time. Then if we revalue the accounts payable because we haven't yet paid it at a later point, you might have a question. You might say, well, doesn't that mean that the equipment that we purchased or the inventory we purchased was valued kind of incorrectly? In other words, shouldn't we put that change in the valuation of the currency into the cost of the machinery or the equipment? And the general rule is no, we're not going to. We're going to value the machinery or equipment at the point in time that it was purchased, even though we had not yet paid for it, using the current exchange rate. And then later, when we revalue the accounts payable or accounts receivable, we will record the gains and losses on the books rather than basically revaluing what like we purchased. So we'll see examples of this. Though there are some exceptions to this when we start to look a little bit later, but that's going to be like the general rule. So settlement date. So then we have the settlement date when we actually, in our example, pay off the payable, or if we receive the receivable, and we're talking like in foreign currency. So now we're going to pay off the payable, and we have to pay in foreign currency, not in dollars. So then we have to adjust the foreign currency payable or receivable for any changes in the exchange rate between the balance sheet date or transaction date and the settlement date. Exchange gain or loss will be recorded. Record the settlement of the foreign currency payable or receivable. So at the settlement date, then we have to do the same kind of thing because now we're going to be paying off. So we bought something on account. Now we're going to be paying it in the future. And we're going to have to revalue then, once again, as of the point in time that we make the payment, the accounts payable, so that it reflects the current exchange rate at that point in time, so that we can then pay in foreign currency and it'll be reflected correctly. So basically, you can think about it this way. If we had the payable, then we're going to pay for it at the end here. So we have to revalue our payable to what the current exchange rate is using the current spot rate at that point in time. Then we're actually going to have to get the foreign currency by basically paying cash and getting foreign currency if we don't have that on our books. And then we're going to have to, and then we'll pay off the payable using the foreign currency, right? And we'll settle it out. So before we can pay off the payable in foreign currency, in other words, we have to revalue what our payable is reflected in dollars to reflect the proper exchange valuation, and then we can basically pay it off in foreign currency or record our receivable in foreign currency. So we have a two-transaction method. So this sees the purchase or sale of an item as a separate transaction from the foreign currency commitment. So we're kind of imagining, although these things are kind of linked in reality, we're seeing them as basically two different things. The foreign currency exchange gains or losses from the revaluation of assets or liabilities denominated in foreign currency need to be recognized in the income statement of the period the exchange rate changes, although there are a few exceptions to this general rule. So you can see it, and basically in our example, we're kind of differentiating the changes in the foreign currency to the purchase of or the sale of whatever our foreign currency transaction is related to. So if we purchased equipment or inventory, then what we're saying is the purchase of inventory, we're trying to keep it kind of separate from the fluctuation in the valuation. So in other words, once again, we put the inventory on the books at the point in time that we got the inventory, even though we had not yet paid for it, or the machinery, even though we had not yet paid for it. We're going to pay for it at a later time in foreign currency, but we're recording it as of that point in time when we got it using the current exchange rate. And we're not going to touch the value. We're not going to revalue the equipment or the inventory that we purchased, even though there's going to be fluctuations in the rate. And there will be exceptions to that when we start talking about hedging and forward contracts and whatnot, but that's the general rule. And then when there's fluctuation in, say, the payable between the point in time that we got the inventory and we pay it, we're not going to revalue or adjust the value of the inventory, but instead just simply record gains or losses with regards to the different valuations of the foreign currency transactions. So we're kind of thinking of them as kind of separate in that sense. Let's take a quick look at an example here. And like I said, I do recommend going over many example problems that we will have. So we're going to say October 1st, we have 2000X1 U.S. company purchases goods on account from a Japanese company. The price is going to be 3 million yen. So 3 million yen. And then we have the settlement of the accounts payable is going to be on April 1st, 2000X2. So then we have the direct spot exchange rates of the US dollar equivalent value of 1 yen. In other words, 1 yen on October 1st is equivalent to $0.007. And then on December, which is going to be our balance sheet date, where we will have to revalue, is going to be 1 yen's worth $0.008. And then on April 1st, 1 yen is worth $0.076. So therefore, if we pull out the trusty calculator here, let's pull out the trusty calculator. Let's pull out a smaller calculator. That one's too big. So we're going to say if we have the 3 million and then multiply that times the current exchange rate on October times 0.007, that's going to give us our $21,000. So our $21,000 if we value it as of October when the transaction took place. So if we didn't have foreign currency and we just recorded this normal, like a normal transaction that happened in dollars, let's say that we purchased the inventory on account, no foreign currency problems taking place, we would simply say that we have the inventory on the books, and then the credit would be going to the accounts payable. And we're not thinking about foreign currency here. We're then just going to say that there's no adjustment at the balance sheet date because we don't have to adjust the accounts payable due to the fact that it's in dollars. It's valued correctly, or it's valued in our valuation. So then we're going to say that when we pay for it on April 1st, then we're going to be debiting the accounts payable, decreasing the accounts payable, and paying it off in cash. And that's the whole cycle. No problem thing is over. Now let's say that we're going to be purchasing this thing, but we're going to be paying for it in foreign currency. What's the added step? What's the added problem that's going to happen here? Well, we're still going to put the inventory on the books, but we're not going to be paying for it in dollars. We're going to be paying 3 million yen. So we're going to say, all right, well, that means that if we're going to pay 3 million yen, we got to say, okay, I'm going to put that on the books and recognize the payable at 3 million times the current exchange rate or spot rate, which will be the 21. So we're still going to record it on the books at inventory 21,000, but we're not going to be paying $21,000. We're going to be paying in yen. And then we've got an accounts payable, which we should reflect that's in yen, which I should have a JPY or something to indicate that the accounts payable is not going to be in dollars, it's going to be in yen. So this 21,000 reflects the fact that we're going to be paying something worth 21,000, but we're not actually exchanging dollars. We're going to be giving the 3 million yen, which currently has an exchange rate to us of the 21,000. So we have to put it on our books at the current valuation, even though we're going to be paying in something other than dollars. Then we're going to say at the balance sheet date at December 31st, we have to revalue the payable. The payable is now on the books at 21,000, but that really reflects 3 million yen. And now the value of the yen has changed. So just like if we were talking about, stocks that are changing on the market, we can now see what that change is because it's a similar market type of transaction. We can say, all right, well now, as of December, that accounts payable is not properly valued according to the current exchange or spot rate. The current spot rate is 0.007. So we're going to say, all right, if I take that 3 million times 0.008 is the current rate. Now it's at 24,000. And it's currently on the books at 21,000. So 24,000 minus 21,000 is going to give us a $3,000 difference. That $3,000 difference is going to be a loss. And why is it going to be a loss? Well, because before the rate was 1 yen was worth $0.007, and now we have 1 yen is worth $0.008. Therefore, the yen has gotten stronger. There's more dollars to the yen, right? The yen is worth more dollars. So the yen has gotten stronger, but we're going to be making a payment in yen in the future, right? So we're going to have to pay with something that has now gotten stronger relative to the dollar, which means that it's a loss to us. It's going to be a loss. So we're going to have to say, all right, we've got a foreign currency loss. This is going to be going on the income statement. So this will go on the income statement, decreasing the net income. And then we got the accounts payable is going to be increasing. Basically, the accounts payable is going to be higher. Right now, it's going to be at the 21,000, which was what we started at, plus the 3,000, which is going to be the 24,000. So once again, that 24,000 is reflecting the dollar equivalent that we're going to have to pay at this point in time, 12/31, of what we're actually going to pay in, which is yen, 3 million yen. So then on 4/1, we're going to have to actually make the transaction. So now we're going to actually pay off in yen what we're going to owe, which is the 3 million yen. But before we do that, we have to revalue once again what's in the payable, which is currently 24,000, to the current rate, which is going to be the spot rate on the point in time that we're going to make the payment, which is April 1st, 2000 x2. So to do that, we're going to say, all right, let's take that 3 million again times the current spot rate, 0.0076, 22.8, what's currently in there, the 24,000 we calculated, which was the 21 plus the 3. And so if we subtract that out, we're going to have a difference of 1,200. That 1,200 now is going to be a gain. Why is it going to be a gain? Because last time we had 1 yen was worth $0.008. Now 1 yen is worth $0.0076. Therefore, the yen has gotten less strong. It's gotten weaker because it's gone down. There's less dollars you get for 1 yen. And therefore, we're going to be paying in yen. So now we're going to be paying in something that has now gotten weaker since it was before. And we're going to be paying in that unit. That's good to us because now we're going to be paying something that has less purchasing power than it did before. So now we're going to say, all right, now the accounts payable is going to go down. Accounts payable is the credit balance. So we're going to make it go down with a debit of the 1,200. And then the other side is going to go into the foreign currency transaction gain. So now we have the gain on the books. So now we have on the books, it's reflecting what it should reflect. And the other way you can calculate this 1,200 is to take the difference between the rates, 0.008 minus 0.0076 times the 3 million. So you can calculate the 1,200 that way. And once again, the current valuation in accounts payable will then be the 3 million times the 0.0076, the current spot rate, that being the 22.8. So the accounts payable is reflected correctly. But in this case, we don't have the yen yet. So now we need the 3 million yen because we don't have it. So we're going to have to get that. So that means we're going to have to pay cash. We're going to pay cash for the 22.8 because that's the current spot rate to get the 3 million yen, which we promised to pay this thing in. So we're going to pay 22.8 in actual cash, and then we're going to get units. We're going to get units of foreign currency, which we're just going to call foreign currency units, which is actually 3 million yen, which of course we're going to reflect on our books, not in a foreign currency unit, but in dollars, that exchange rate being 22.8. So now we have on our books an asset of 22.8, very liquid asset being the cash, right? But, or the foreign currency, but we're still reflecting it in US dollars, just like we would if it was, stocks or something like that. So it's on the books at the 22.8. Then now that we have the foreign currency on the books here, we would then pay in foreign currency. So we've got this asset of the 22.8 reflecting 3 million yen, which we're now going to credit, removing the foreign currency, paying actually the 3 million yen, reflecting it on our books as a decrease in the foreign currency of 22.8, the US dollar equivalent. Then we'll be paying off the payable, meaning the payable will go down to 0 with a debit, decreasing what was currently on the books at 22.8 down to 0, reflecting the fact that we owed 22.8 in, which really reflected the 3 million yen in US dollars equivalents. Now that US dollar equivalent has gone down, the 22.8, because we actually paid, the 3 million yen. So that's going to be a quick example. When we go through the example problems on our future example problems, we will actually post this out to trial balances so you could see the increases and decreases. Some of these accounts, if you're not used to foreign currency, will be new to you. The idea of having accounts payable that reflects foreign currency is probably new to you if you haven't worked with foreign currencies before. So it's really helpful to see them posted to a trial balance. And so once you see that a few times and see these actual posted out, it will make a lot more sense. So I recommend taking a look at those.